Welcome to this explainer. Today, we are going to completely demystify the stock market, absolutely eliminate your fears, and build a rock-solid foundation for your investing journey. Look, if you've ever felt nervous about share markets, or maybe you've been told by your family to stay far, far away from them, you are in the exact right place. Today, we're clearing up all that confusion once and for all.
Okay, let's jump right into our roadmap. We'll be covering the market's true power, the truth of risk and return, how to turn 1,000 rupees into 1 crore, why the market gets a bad reputation, how it actually works, and finally, how to start your investing journey.
All right, Section 1, the market's true power. Let's unlock the actual potential of investing.
We're going to kick things off by shattering a pretty massive misconception and looking at the incredible and honestly kind of surprising potential of stock market investments. It is shocking, but it's totally true. In a famous U.S. survey, when asked to pick a basket of 10 stocks, a group of 10-year-old first graders actually outperformed a group of expert chartered accountants. I know, crazy, right? The adults relied on super complex financial calculations and incredibly dense balance sheets. But the kids? They simply chose the quality products they already knew and loved, brands like Cadbury, Disney, and Barbie. They understood the customers because, well, they literally were the customers. It just goes to show that basic observation often beats complicated math.
And this brilliantly illustrates the market's true power. I mean, to put that into perspective, a mere 10,000 rupees invested in Wipro 40 years ago would have grown into a staggering 700 crore rupees today. Even if it was just 1,000 rupees, it would be 70 crores today. That is absolutely mind-blowing. This is the ultimate potential of the stock market. It literally has the ability to create massive generational wealth. But of course, to capture that upside, we do have to talk about the flip side.
Which brings us to Section 2, the truth of risk and return. It's crucial to understand exactly what you're getting into. When we're dealing with that kind of massive potential, we really have to address reality. So the crucial point here is that investing in the stock market is exactly like investing in a friend or family member's business. You are buying a small piece of ownership. If their business fails, well, your money sinks. If the business booms, your wealth grows right along with it. You aren't getting a guaranteed fixed interest rate like a bank loan. You are sharing the exact risk and the exact reward of real companies like Tata or Reliance.
And because of that risk, you wouldn't just invest in one single company, right? You build a portfolio of at least 8 to 10 solid companies so that if one happens to fail, your whole wealth isn't wiped out. If you do this properly in a high-growth economy like India and you hold on to those stocks for at least 5 years, you can realistically expect annual returns of around 18 to 20%. That heavily outperforms the returns of fixed deposits and is almost double what you might expect from gold or real estate.
So, moving on to Section 3, 1,000 rupees to 1 crore. Let's talk about the absolute magic of compounding.
Let's see how this actually builds into massive wealth, because you absolutely do not need to be rich to start investing. By following 3 incredibly simple, disciplined steps of compounding, you can turn your basic monthly savings into a literal fortune. Step 1, just start with 1,000 rupees a month. Step 2, every year, as your salary or your pocket money grows, increase that monthly investment amount by just 15%. And step 3, just let it sit there and earn a very realistic, very conservative 15% annual return over 25 years.
Now get ready for this. Following that very simple math transforms just 1,000 rupees a month into an incredible 1 crore rupees over 25 years. It's all about consistency, not massive upfront cash. It's just time, discipline, and letting the magic of compounding do all the heavy lifting for you.
Okay, Section 4, why the bad reputation? If the math is this good, it proves that mindset is literally everything.
Seriously, if the math is this rewarding, why does the stock market have such a terrible reputation among our families? Why do the movies always show it ruining people's lives? Well, the bad reputation comes entirely from a flawed mindset. Think about it. When people buy real estate or gold, they are incredibly patient. They pass gold down for generations. They wait years and years for a property to appreciate. But when those exact same people enter the stock market, they suddenly treat it like a casino. They buy random 1 rupee penny stocks without even glancing at the business model, just hoping their money doubles in 2 months. Treating stocks like a lottery ticket is a guaranteed way to lose your money. And that is exactly where the market's bad name comes from.
Section 5, how the market works. Let's demystify the actual mechanics of trading.
To stop treating the market like a casino, we just need to understand how the machine actually works. It's honestly a beautifully simple exchange. Imagine a company wants to build a massive electric vehicle factory, and they need, say, 20,000 crore rupees. Banks and friends definitely can't lend them that much. So the company goes to the public. They explain their business plan, and the public provides the money. In return, the public gets company shares, a literal piece of ownership. And because you might need your money back tomorrow, these shares are traded daily on the open stock market, meaning there is almost always a buyer or seller waiting for you. You literally get to be a true partner in massive empires with just the click of a button.
And listen, you absolutely do not need a finance, commerce, or engineering degree to participate in this. In fact, busy professionals, particularly female doctors, often make the absolute best investors. Why? Well, because they are way too busy to sit around and overanalyze complex balance sheets. They simply buy shares in good companies whose products they actually understand. And because they don't have the time to constantly check their phones and trade, they leave the investments untouched for years. This avoids pesky transaction costs and allows that compounding we talked about to work its magic flawlessly.
Finally, Section 6. Start your investing journey. How to take that very first step today.
Now that we've cleared up the myths and the mechanics, it's time to equip you with the practical steps to begin your journey today. Taking action is incredibly simple now. Opening a demat account, which is essentially just a digital bank account to hold your shares, with a modern online discount broker takes a few days, can be done entirely without any physical paperwork, and cost almost nothing in commission when you buy and hold shares. You just need 3 basic documents ready to go: your Aadhaar card, your PAN card, and a standard bank account. That's the whole shebang.
And to continue building your foundational knowledge beyond this explainer, I highly recommend diving into these specific beginner-friendly books. Start with Rich Dad Poor Dad to really lock in your financial mindset. Then check out Learn to Earn by Peter Lynch. It is absolutely the best explanation of market basics out there. And when you feel ready for some slightly more advanced, high-quality knowledge, definitely pick up The Education of a Value Investor by Guy Spear.
So we've covered the potential, the mechanics, the mindset, and the math. Now it's your turn. Just like those 10-year-old kids who succeeded by picking the brands they loved and naturally understood, I want you to look around your house, look at the products you use every single day, and ask yourself, what will your very first stock be? Do your research, trust your observations, and take that first step towards building your wealth today. You've got this.